Welcome back, Adam here. I hope you are all well. Today I want to share my thoughts on investing in a downward market. Spoiler alert, it does involve doubling down on some positions, so always very important that you keep a cash position on hand for this type of situation. What would be very useful for me if you could share your thoughts with me down in the comments and let me know those companies, those stocks that you have full conviction over. What are the companies that you double down on in a downward market? Now, the past few weeks have not been enjoyable for investors. Some industries hit harder than others. Certainly technology's been hit hard. The energy sector, very hard. It doesn't seem like there's any real safe haven at the moment. Recovery stocks are down. Cryptocurrencies have been down as well. So I want to share with you a few points that we should all be reminding ourselves when it is an ocean of red out there. And then one practical way that I use just to focus my efforts a little bit. First of all, it's nothing we didn't know when we entered the market. We know valuations go up and we know that valuations go down and everywhere in between. The good news is that over time, it's slightly weighted in favor of valuations going up. Just like when you go to the casino, the roulette table is slightly weighted in favor of the house. The casino never panics when people win big at the roulette table because they know over time it's weighted in their favor. And there are some similarities there with the stock market as well. The best way to remind yourself of this is get off the 1 day chart, get off the 1 week chart and zoom out. Look at the 1 year, look at the 5 year. You'll still see those downward turns there, but in the longer run, you'll see that they don't have much significance. Secondly, when we're in a bull market and we've had days and days and weeks of green, we beg for an opportunity like this, myself included. How many times have people said, I wish I got in on Tesla sooner, I wish I got a better entry point for Tesla, I would have put so much money in, I would have made so much money. Then all of a sudden, you're presented with that exact opportunity, and what happens? A lot of people freeze up and they're not able to seize the opportunity that's right there in front of them. So it's very important to remind yourself that these are solid companies, and where they have solid fundamentals and they're on the right side of societal changes that we're seeing, like these EV manufacturers, then the highs that they have set previously should be seen as a glimpse into the future. And the pullback that we're currently seeing should be seen as an opportunity to load up on good companies at a discounted price. And finally, trying to time the market is very, very difficult. Experienced investors and traders often get this wrong. So I think it's very important to be happy with the price that you get and not focus too much on the price that you could have got. If you focus too much on waiting for the price to drop a little bit further before you buy in, you'll notice the market finds a bottom and then it often rebounds very, very quickly and you miss your opportunity altogether. So personally, what I like to do is when I start to feel the pain and when your previous gains are really evaporating away like they have been recently, unfortunately, that's when I'll start nibbling on some of these stocks. As it pulls back further, I'll nibble some more, and if it pulls back more, I'll start buying heavier, and I'll continue to do that until I run out of cash. Now I'm going to switch across to the laptop and I'm going to share my screen, and then I'm going to show you one practical way that I use just to really focus my efforts in these times. Now, I always maintain a basic spreadsheet with all my open positions in. Some people like to add in companies that they're watching as well. And I always keep basic information in here. I've hidden away a lot of the sales, but any information that you find relevant, this is a good habit to get into anyway. But if you think about your portfolio plus a potential watch list, you could have hundreds of companies in here depending on how many you watch at one time and how big your portfolio is. What I like to do is run through these positions here and pull out maybe 10 or 15 companies that I am full conviction on. I'm not saying the others are not good companies, but I'm saying these are companies where if I had to bet my house on them, they are the companies that I would bet on at the moment. The companies that I believe in 2 or 3 years' time will be much bigger, much more influential, and much more profitable companies. Once you have your list of companies that you have full conviction over, and I'm not saying this is the correct list for anybody apart from myself, I also like to put in the year-to-date high, the current price, and then the percentage fall from those highs that we've seen. Now, I use the year-to-date high because we don't want to look back too far. You don't want to be comparing to highs that these companies hit 2 years ago because the current downturn is having no impact on that. You also need to be careful of companies such as Churchill Capital. Churchill Capital had a revaluation of their target company, Lucid Motors. So I've had to iron that out. I've taken a high since the revaluation. Tilray, another good example. Wall Street Bets had a good run on this company for a day or so. So I've had to ignore that spike in share price that we saw and taken a high again since then. But then once you've done that, you can order them in terms of the percentage off of those highs that these companies are. I find that by doing this, it just helps you to keep track of things. Often in an ocean of red, day after day of red, it's hard to spot the real bargains and keep track of how far these companies have fallen. So this will just give you a little bit more focus and a bit more perspective. Of course, the amount that a stock has fallen from its highs isn't the only indicator that you should be looking at, but it might just help you to weed out a few companies that maybe aren't as discounted as you might have thought. At this point, during this downturn, I would probably say that 25% is a substantial pullback. It's substantial enough that I feel that it's heavily discounted now. Because remember, in this current downturn that we're seeing, apart from fear of inflation and fear of rising rates, there isn't actually that much going on. Maybe some slightly inflated valuations we saw, but there's not that much to cause it. So 25% is substantial to me. The second factor that I like to take into consideration is, are these companies profitable companies? Because at the end of the day, if it does get really bad, then that's what's going to be important here. And considering those two factors, more than a 25% fall and have they delivered positive earnings results, I can spot off the top of my head 2 companies there that fit that description. So I'm going to highlight those 2 companies in green first of all. Following that, I would look for companies that have suffered more than a 25% fall from their highs and that are loss-making companies. You'll notice that I leave out Churchill Capital, and that's for a personal reason. They haven't delivered a vehicle yet, although I love the company. They haven't delivered a vehicle yet, which makes them slightly higher risk, so I'm going to leave them out. And I'll go ahead and highlight those companies that I've selected in orange. Anything remaining can then be highlighted in red, and we're left with a little bit of a traffic light system. So very simple, I know, but it does help to organize. So now anything that's in green, green is a signal for me to start buying, and start buying with confidence as well, as if you already know the outcome of this one. Orange is a signal to nibble on these stocks, and if they do fall further, then I'll start buying a little bit heavier. NEO is a good example. I was nibbling on NEO this morning, just under $36 per share. And then finally, red, I'm still high conviction on these, but I would like to see them pull back a little bit more before I start nibbling, and a substantial pullback before I start buying heavy on these ones. Churchill Capital, for example, I would like to see that below a 30% fall before I really start buying into this one. For some reason, I would expect Churchill Capital to have suffered a bigger loss than your Teslas and your NEOs, given that they haven't actually delivered a vehicle yet. It's also important not to get sucked into deploying all of your cash into the market too quickly. Sometimes we see a flash of green, we think that we found a bottom, and we throw all of our cash at stocks as quickly as we can. Of course, once we've done that, the market pulls back more and we're left on the sideline with no more cash to put into the market. So just be a little bit careful. I like to have a game plan. I like to stick to that game plan. If the market does rebound quicker than I was expecting, that's fine. I'm not going to see it as a missed opportunity. I'm already in the market with my existing portfolio, and that'll go back to work for me. That's not a problem. I'll actually be relieved that I didn't have to deploy more cash into the market in that situation. Yes, of course, you need to be greedy, but you also need to have patience. In conclusion, I would say stay calm, narrow your focus to your 5 or 10 high confidence, high conviction stocks that you really believe in, set a game plan and stick to it. Don't let emotion take hold and force you into bad decisions either. Now, I'm really interested to know what your high conviction stocks are, so if you can let me know down in the comments. Thank you all for watching, and I'll see you next time.